It looks like 2015 will be another year of weak global growth. We expect global economy to grow at 2.8%, a bit lower than what we expected in January. We anticipate while growth to accelerate in advanced economies, it will be weaker in developing countries. For developing countries as a whole, we expect growth to be around 4.4% this year. This will be the fourth consecutive year the growth has been disappointing in these economies, suggesting a persistent growth slowdown has been underway. Against the background of this weak growth, developing countries are facing two major transitions. The first one is to transition to an era of low commodity prices. And the second one is to transition to a world they will face higher borrowing costs when the US Federal Reserve starts increasing interest rates in the near term. US Federal Reserve officials have clearly set out a path to increase the interest rates for the first time since 2006. Our baseline is that the tightening cycle will be a smooth one. However, there are risks around this baseline. As we painfully learned during the so-called tantrum episode in 2013, even highly anticipated changes in monetary policies can surprise markets in their specifics and lead to financial market volatility. If borrowing costs increase suddenly for developing economies, that can lead to a sharp decline in capital inflows. This will highly likely to coincide with depreciations in their currencies and decline in their asset values. Policymakers in emerging and developing countries need to be ready to these types of risks. They need to have strong monetary and fiscal frameworks to make their economies resilient to external shocks, including a possible shock with sudden increase in interest rates. Low-income countries have done remarkably well during the 2000s. In fact, they have been able to grow on average 2 times faster than they did during the past 2 decades. Their successful growth performance has been driven by boom in commodity prices. New discoveries of oil, metals, and mineral fields help these economies to increase income, to increase public spending, and to increase wages. Now, since 2011, commodity prices have been declining. This is creating a challenging environment for low-income countries. For the moment, we think that their growth performance will remain robust. However, policymakers in low-income countries, especially those relying on commodities for their export earnings, need to adjust to this new environment by undertaking policies that can foster broad-based growth.